Hello and welcome back to the Trinity Student Managed Fund podcast with me, Emanuele Roncalli di Montorio-Veronese, where I speak with leaders in the world of business, finance and technology to give our students a better insight into the careers we may wish to pursue. Today's episode is sponsored by Setanta Asset Management, a Dublin-based boutique investment manager specialising in equity and multi-asset strategies with a fundamental value approach since 1998. With a proven track record of strong performance and 13.2 billion euros in active assets under management, Setanta serves a diverse client base, including institutional insurance, pension funds, charities and family offices across Ireland, Germany, Canada and the United States, applying a long-term investment philosophy that clients value. Today, I sit down with banking legend Mr. Bob Diamond, who is the founding partner and chief executive officer of Atlas Merchant Capital. Until 2012, Mr. Diamond was chief executive of Barclays, having previously held the position of president of Barclays and was responsible for Barclays Capital and Barclays Global Investors. He became an executive director of Barclays in 2005 and was a member of the Barclays Executive Committee since 1997. Prior to Barclays, Mr. Diamond held senior executive positions at Credit Suisse First Boston and Morgan Stanley in the US, Europe and Asia. Mr. Diamond worked at Credit Suisse First Boston from 1992 to 1996, where his roles included vice chairman and head of global fixed income and foreign exchange in New York, as well as chairman, president, and CEO of Credit Suisse First Boston Pacific. Mr. Diamond worked at Morgan Stanley from 1979 to 1992, including as head of European and Asian fixed income trading. Mr. Diamond is currently chairman of the board of directors of Concord Acquisition Corp, chairman of AGBA, and a member of the board of directors of Crux Informatics. Mr. Diamond also serves on the Yale SOM Council of Global Advisors. A native of Concord, Massachusetts, Mr. Diamond holds a Bachelor of Arts degree in economics from Colby College in Maine and an MBA from the University of Connecticut. He was awarded Doctor of Humane Letters from the University of Connecticut and Doctor of Laws from Colby College. I hope you enjoy this conversation with Bob Diamond. Mr. Bob Diamond, welcome to the Trinity Student Managed Fund podcast.
What an honor. I'm glad to be here.
So, obviously, as our listeners will have heard in the pre-recorded introduction, you have been at the center of global finance for over 4 decades. You built an international bank, investment bank at Barclays, which obviously oversaw the historic acquisition of the US business of Lehman. But I'd like to bring it back to the start. We're an Irish university. You have a connection to Ireland. Could you talk more about this and your sort of early life?
Well, I grew up in Western Massachusetts, both, from Irish Catholic family on both sides, my mom and my dad. My mom's maiden name was Keogh, which is actually a name that I run across probably more often in Ireland than I do Diamond. The Diamond name was Northern London. But yeah, I think in the generation I grew up kind of post-World War II, the Irish Catholics were a very recognizable group in New England and Massachusetts. And I was always very proud to be a part of that.
And you were one of 9 children?
One of 9 children. As I love to tell my sister, I was the oldest male and second oldest child. It's interesting. In the time that we grew up, it was very common to have families of 5, 7, 9 or more children. And, when I look back at growing up, all of my cousins were from families or I would say most of my cousins were from large families as well. Not as common today, for sure.
And what were you like growing up, if I could ask? What was it like being at the dinner table?
That's a really good question. My mom and dad were both school teachers. Having children, my mom gave up teaching, but my dad was always an educator. And I think being a teacher, he was home virtually every single night for dinner. So dinner was always a family event, which was a very positive part of my upbringing. And it wasn't complicated for me. Like most young people growing up in New England, all I wanted to do was play sports every morning when I got up. School was kind of fun. It was where all the other people were. But, the second we had a chance to get out to recess and play sports or after school playing on the team, that's what my upbringing was.
I can imagine. I'm one of five, so the dinner table is very noisy. I can
Yeah,
imagine one of nine must
it
be.
was noisy. It was organized. My mom was, would cook dinner every night. We said a prayer before we ate, of course. And my dad would always say that was to give everyone a fair start and let no one get ahead of anyone else.
That's the way to do it. And I'd love to ask, so during university, what kind of were your thoughts at the time and what you wanted to do? And then also, as a kind of second question on that, you obviously have an MBA from the University of Connecticut's Business School. Would you recommend an MBA now? And this is a topic people at Trinity are kind of
Yeah.
thinking about.
The U.S. has a somewhat unique university system where there are very large, often state universities and private universities with both undergraduate and graduate programs, very, very steeped in research and writing for the professors. And then there are the smaller liberal arts schools. And Colby, where I went to college, is a good example. All of my relatives, my brothers, my sisters, my cousins, my aunts, my uncles, my grandparents, all went to the University of Massachusetts in Amherst, which was a large state university, as I had referred to. The advantage of the small liberal arts schools are many. One is it truly is a teaching institution. There's no graduate school, it's just the undergraduate students. Classes are generally 10, 11, 12 students. Very close relationships with the teachers. The liberal arts education means that while you have a major, in my case, my major was economics and my minor was education, you really get a very, very broad view. So we were required to take courses in the sciences and in math, for example, even though they weren't our major. So it's a very broad education. I think the other advantage to me, to be perfectly frank, was at a small school, I could continue to compete in sports for 4 more years. I played both American football and baseball at Colby. And had I gone to a larger university, I knew I didn't have a chance to make the team. I wasn't that good. But at a smaller school, I did. And I think sports is a very important part of learning, learning to be a leader, learning to be a teammate, learning to be part of a team. And I loved it. So I think one of the great attributes of the university system in the U.S. is the opportunity to, choose something that is more liberal arts, more small, more undergraduate focused. But also there's just, so many great larger universities that are more research driven as well.
And on the MBA, we've heard Nikolai Tangen say it's great for career pivot. Would you still?
I think it's a very personal decision. I think in some ways in my generation in banking, it was, I wouldn't say a requirement, but it was close to that. I don't think it is today at all. And I think that financial services is a, much more diverse industry. It's not just large banks, but it's hedge funds and private equity and venture capital and research. And I think it's a very personal decision of whether it's worthwhile to take time off and get a master's degree. In my case, I got my master's degree while I was teaching. And my intention was to teach organization and interpersonal skills. Teaching was what I had always planned to do during college and what I was planning to do post-college. And that was really why I got a master's degree. It wasn't that I had been in financial services at the time. But I think, coming back to your question, I don't think everyone needs to plan to get a master's degree. I do think getting a master's degree is somewhat of a privilege. It's wonderful to be able to continue your education, but I think everyone has to balance it with other aspects of how they're doing in their career.
And what was the process like going from teaching into the world of finance? How did that come about?
Yeah, it was all a little bit happenstance. Having taught for 2 years, I knew I needed to be successful. I needed to get a doctorate, and to be successful, I needed some experience. I was teaching organizational behavior, and I was teaching it. My interest and I guess my focus was on experiential. So desert survival exercises, things like that, so people can understand the impact of other people's behavior on them, how to be a leader, and I loved it. But it was really hard without a PhD and without management experience to be credible as a professor. So I tried to accomplish both by looking for a job that would give me real experience, particularly in management training, while at the same time giving me a chance to save money to get my PhD. And I took a job at a company called United States Surgical in Connecticut, and it was for that time very techy. It was developing some new medical procedures around suturing and using staples as opposed to thread in suturing. At any rate, it was a fantastic training program. I got unbelievable experience. I was given a lot of responsibility. And it was when I first learned what a true mentor was, someone who would inspire me every day, who I would kind of hang on every word, but was also someone who was very involved in the day-to-day work, and someone that I got a chance to work with. And this was a gentleman named Bill Cook, who ran all of the hiring and training programs there. And after 2 years, when I was thinking of then going back and getting my doctorate, Bill took a new job, sat down with me and asked me if I would be willing to consider leaving and going with him. And the firm he was going to was Morgan Stanley, which I say in your notebook right there. And my first question to him was, who is Morgan Stanley? So for someone who was a college graduate to not even know who Morgan Stanley was at the time gives you a good indication of how little knowledge of financial services I had at the time. His role was to build the technology that would allow Morgan Stanley to compete with Salomon Brothers and Goldman Sachs away from their tradition of advisory and M&A into the, I would say, the rougher business of sales, trading, and research. And so that was the entree of Morgan Stanley, away from just giving advice into also dealing in securities and trading. And I worked with Bill to set up the program to build the technology, and was lucky enough to make the contacts and relationships to get hired onto the fixed income trading floor after 2 years of working with Bill. And that was in the early 80s. Paul Volcker was head of the Fed. Interest rates were just going into low double digits. They went up into the 20s from there. So people that worry about 5% interest rates being too high today just don't remember what it was like when we had a raging inflation in the 70s and early 80s. I've got to tell you, though, you could not have had a better training ground than to be part of a trading desk when the Fed was going through such a very, very challenging period in tightening interest rates the way that they were. So I feel none of that timing had anything to do with me. I think it was just very fortuitous that I got into the financial markets during that time.
And then, of course, fast forward to 1996 when you joined Barclays. You built such a successful investment bank, which was before primarily UK focused, unprofitable, and then 12 straight years of 20% compounded increase in profits and revenue with no quarters of losses. I mean, I'd love to ask kind of what were the steps you took in this transformation, and how did you do it?
Listen, the move from a investment banking platform, which was not part of a big bank like Morgan Stanley. What's the thinking in going to an institution like Barclays, where it had a great commercial and retail bank, very UK based, but not much of anything else that was successful? Their investment bank, as you said, was very sterling-based and UK-based. That wasn't a big part of the global markets at the time. Barclays had aspirations, as did other European institutions such as Deutsche Bank, NatWest here in the UK, BNP and Paribas in France, Santander and others in Spain, to compete with the U.S. bulge bracket banks in investment banking and in asset management. And so my hiring by them was kind of a statement that they wanted to bring some of the skills and acumen from the Americans who had been building investment banking for years, not just in the U.S., but I was lucky enough to move to London with Morgan Stanley and be part of building the international business. I also think that, in those days, being a large AAA rated bank like Barclays was a huge competitive advantage. Capital levels were much lower, regulation was much lighter touch, and we had the ability to invest in that business and build that business over years. And I think when I look at our principles, the principles that with my executive team we put in place, they were very much about building to last, not just trading the markets, but building businesses that would be sustainable and profitable for not just months, but years and decades going forward. And in doing that, we had to be sure to build things that would last and not try and do too many things at once. So we focused very much on becoming the dominant firm in sterling. We then, anticipating the introduction of the single currency, which came in 1999, recognized that before we could be credible in the dollar market with big US companies, we really had to earn our stripes as not just a great UK sterling firm, but a great Euro firm. And so we focused very much on building our business across Europe, competing with the European banks, which I felt, we had pretty good level pegging, but against Goldman Sachs and Morgan Stanley and Credit Suisse First Boston and Salomon Brothers to compete for the big dollar mandates, even for your UK corporates and the UK central bank, was challenging. And so starting in 1999 and 2000, with the success we'd had in sterling and euro, we made a big statement with hiring a large group of people from Credit Suisse and Deutsche in the US. And having started that with winning a very big mandate from the Bank of England to do one of their dollar deals. So we were trying to make a first move into the dollar business. But there wasn't, it was at a time when you couldn't look and say, here's the model of success. Here are the 15 non-US banks that have been successful in the dollar market. Deutsche Bank, I think in the early days, to a small extent. Credit Suisse with their acquisition of First Boston. UBS on the fringes. NatWest on the fringes, the French banks, the Italian banks, the Spanish banks, again, on the fringe. So it was a pretty big move for us, and it worked quite well. But again, we're building one business at a time, one block at a time. And I think the other thing that we did well is we stayed very, very focused on those areas of the business, like fixed income, lending, derivatives, that could take advantage of being a large AAA rated bank, and stayed away from businesses like new issue equities and M&A advisory, which really were the big competitive edge of the U.S. bulge bracket banks because of their success in the much bigger market in the U.S. And so we tried to we were very much not trying to say we can be all things to all people. We wanted to stay very, very focused on the things that we could do well. And I know I'm jumping ahead a little bit, but in an interesting way, it's why we were better positioned than Deutsche or any of the other European or US banks to acquire Lehman during the crisis, because Lehman had an outstanding US business and an outstanding M&A and equity business. And we really had none. So the combination of the two for us had much less duplication than it would have had for many other banks. We really, you can't anticipate that someday there's going to be a crisis and you're going to be able to acquire a bulge bracket bank like Lehman Brothers. But what you can do is to be honest with yourself and make sure that you're only doing businesses where you believe you can excel. Because at the end of the day, clients are only going to do business with firms that will make them better.
And could we talk about 2008? Because you obviously had a great view of what happened. I mean, firstly, on a personal perspective, 15th of September 2008, the morning waking up, what was that like, seeing that on the news? I mean, most of our listeners, myself included, we were very young. We weren't really aware of, we read it in the history books and so forth, but what was that like? And then also, the acquisition.
Well, first of all, I didn't wake up because I never went to bed. I hadn't been to bed since, I think, the Wednesday prior. That was the day when my boss, John Varley, who was the CEO of Barclays, and I was the president, my responsibility was the investment bank, Barclays Capital, and the asset management business, Barclays Global Investors. And on Wednesday, John and I talked with the support of the board to Hank Paulson and Tim Geithner when it was clear that they were trying to arrange a sale of Lehman Brothers over the next couple of days. We knew they were talking to a number of other banks, including Bank of America, including Merrill Lynch, although I think it was more Bank of America. And we had a very critical call, which was really to ensure that they would be serious about Barclays' intent and that we wouldn't be disadvantaged if we're competing with a U.S. bank for the acquisition of Lehman Brothers. And so Wednesday night, I flew over with 3 of my most trusted colleagues from my executive team, and we spent literally the next 10 days through that weekend, and then the following week after Lehman claimed or declared bankruptcy to acquire Lehman Brothers. First, over the weekend, the entire firm, and then once that wasn't approved by the U.S., which we can go through a little bit if you're interested, but we immediately pivoted to trying to buy the U.S. platform out of bankruptcy. I didn't get any sleep. It was a very, very interesting time, stressful time, but we had to stay on it every step of the way. So trying to grab an hour here, an hour there was pretty much all we did for a week.
And sort of 2 parts. I mean, firstly, looking back, like, what do you think are the main lessons we can learn from it? And then also, if you could speak to Hank Paulson and the British regulators again, what advice do you think, looking back, should have been given? Do you think it could have been handled differently? Or
listen, hindsight is 20/20, and it's easy to look back and criticize. I think Hank Paulson was a giant. He was put into a very difficult position as Secretary of the Treasury at a time when we all saw there was one calamity after another, which were not all of his making. From the agencies to AIG to Lehman Brothers to UBS pretty much imploding in the summer of 2007, BNP Paribas breaking the buck with their money market funds, Bear Stearns bankruptcy in March of 2008. Through all of this, and it was really triggered by the Bear Stearns bankruptcy in Easter of 2008, it was pretty clear that there could be other shoes to fall, that the crisis wasn't over. Hank Paulson was Secretary of the Treasury. I knew Hank not that well, but I knew his Undersecretary of the Treasury, Bob Steele, very well. Both of them were Goldman Sachs partners. Bob had been on our board at Barclays and left the board to take the job with Hank as Undersecretary. And I talked with him right after the Bear Stearns bankruptcy and said that again, with hindsight, rather than put a call in to just JP Morgan to rescue Bear Stearns, if something like this happens, you should count on me and count on Barclays to be able to ask if we can help as well. We can't guarantee it, but I would certainly be willing to engage with John Varley, the CEO, and the board if there were a similar situation. A few months later, so it was probably in May or early June, I got a call back from Bob, which said if there were another shoe to fall, one, would Barclays be interested, and two, if Barclays would be interested, how can we at the Treasury help? It was fairly clear to me that what he was thinking about is the potential of Lehman Brothers failing. And if you look back, Lehman was doing well and then poorly and well and poorly. The stock price was up, the stock price was down. This was over 6 months from the Easter debacle of Bear Stearns through the September bankruptcy of Lehman Brothers. I think it's one of the great lessons of business I learned is that we immediately took that seriously and started doing some planning. So with my executive team in Barclays Capital, the investment bank, we spent 3 or 4 pretty heavy-duty sessions going through kind of mapping Lehman Brothers and Barclays Capital and what would be the advantages and disadvantages. Would it be a credible combination? And we then took our findings to the board to talk with them. And the findings we presented were that probably the single best combination of any two banks was Barclays and Lehman Brothers. There was less duplication because of some of the things that I talked about, that our investment bank matched well with Lehman. Lehman was weak in Europe and Asia. Barclays was very strong. Lehman was very strong in M&A and equity, not quite as strong in derivatives, and was really not in lending. Barclays Capital was very strong in lending, very strong in derivatives, and we were both pretty strong in fixed income. That's where the overlap was. But to be perfectly frank, we also realized that since so much of a merger of two investment banks is the talent, and that the assets literally go up and down in the elevator every day, that the only way it was going to work is if it was at a distressed price. So the presentation we made to the board, and we had 2 long sessions with the board, is if there were a situation where Lehman was available in distress, we should be prepared to act. And in theory, it was a great meeting. The board agreed with all of that. And I can remember as if it were yesterday in June at our final session on Lehman Brothers and making a decision, what I said to the board was, we appreciate your support. We would very much like to propose a merger with Lehman Brothers if it's at a distressed price. But keep in mind, if Lehman is at a distressed price, the world is probably going to be falling apart. Those things aren't going to happen independently. Or at least the financial system is going to be falling apart. But I think all that work meant that when the call that Wednesday before Lehman weekend, the call went in, our board was supportive of us getting involved because we'd done all the work and we understood how the match would work. And I think for another bank who had not done all that work, it's very hard in the middle of a crisis like that to actually get your board together to start thinking about proactive actions when everyone's worrying about how are we going to survive until Monday.
So planning, being prepared is
being prepared. Yeah.
Best lessons from 08. And I suppose just lastly on the kind of negotiations and what that was like with Lehman. Obviously it was the large, I think still today, even the largest bankruptcy in history. On a personal level, what was it like? What was it like? Was that just so much uncertainty? And
I think Lehman had been through so much that year and had been looked at for an acquisition by a Korean bank. I mean, so many, if you go back in history, there was so much that the truth is that when we got there Wednesday night and spent all day Thursday and all day Friday doing due diligence, to be perfectly frank, there was nothing we didn't understand well, with one exception. because they had been going through due diligence with so many potential partners for so long. When we made our proposal to Secretary of the Treasury Paulson and President of the New York Fed Geithner on Saturday morning, the two conditions we had were that they had to ring fence the $40 billion of real estate assets that were not part of the core business, but had been in an investment portfolio, and there was very, very poor records. It was very hard to value. And our proposal is ring fence that and take it out. And then secondly, being a foreign bank, and a UK bank, which it would take a shareholder vote to provide a guarantee for all the transactions Monday morning, that we needed the Fed to guarantee our clearing and our transactions Monday morning when we woke up Monday with a new combined bank. I can remember very, very well Secretary Paulson saying to me, and I was aware that he had made a pledge publicly that it was going to be no more government money put in any bank rescue. And he said, Bob, if you want to ring fence that $40 billion, you better get on the phone and find out who's gonna fund it. And I said, with all due respect, Secretary, there's a good deal here to get the 25 biggest banks to each put in $1 billion to fund that. And to fund it, if it returns money, great. If it doesn't, is it better off to have lost some money on that or allow Lehman to collapse? And I said, I think the banks would all agree that trying to rescue that $40 billion in assets is the right thing to do. But secondly, with all due respect, I don't think any banker is going to return my phone call today, and I suspect all of them will return yours. So I think you have to make those calls. I don't think I'm going to be able to do it. And within a couple of hours, we had the whole thing funded. And my sense was correct, which is that it was far better to take a bit of risk on a portfolio which was opaque. We knew there was $9 billion, for example, of Japanese real estate, but we didn't have a good idea of which buildings it was. So we were limiting our losses to a maximum, say, of $1 billion, as opposed to what could happen if there was a collapse of Lehman Brothers. The Fed never was able to approve. They felt that the UK should provide the guarantee, and the UK position was very clear. This is a US problem. Lehman Brothers is a US problem. You need to provide that guarantee. My sense is that Secretary Paulson felt that was, well, maybe you and I and most of my peers would agree that the Fed guaranteeing clearing of securities really doesn't imply much risk. Technically, there is risk, although the Fed owns the whole clearing system, so they can control it. My sense is that Secretary Paulson was worried that the average person would see that as a government bailout, and it would impact anything further that the Treasury had to do. And my sense, I can't guarantee this, but my sense is at that time, Secretary Paulson was learning how bad the situation at AIG was, which is, if you recall, the next week it became clear that AIG was bankrupt as well. So I think it was a very complicated time, but to make a long story short, the decision was made to allow Lehman to go into bankruptcy. I'd like to say we had thought about that possibility, but we really thought it was going to be rescued by us or B of A. And we hadn't thought that once they go into bankruptcy, there's an opportunity to buy just the piece we wanted, which was the US broker-dealer, out of bankruptcy. And that became very complicated because, as we all know, bankruptcy court can go on months and months and months. So we contacted the bankruptcy judge, Judge Peck, and said, this is a melting ice cube. We will buy this out of bankruptcy. We'll save 10,000 jobs in New York. We'll integrate the investment banks. I think it will be a great development for the economy, for employment, for saving jobs, for just good. But we need a decision today. We can't go through a long process. And much to his credit, he said, I hear you. I'll make a decision by Friday evening. And so we went through that whole week, Monday, Tuesday, Wednesday, Thursday, where I'm telling the Lehman people, we don't own you, but come into work. keep the phones going, do everything you can in bankruptcy, keep this business going, and we'll know by Friday night whether or not there is a merger with Barclays. And of course, the judge ruled favorably Friday evening, and we opened as Barclays Monday morning. Amazing.
Really, I mean, we've all watched the.
And I finally got some sleep.
It's so surreal to hear. I mean, because we've all watched, The Big Short and see the documentary. It's interesting to hear the war stories from your perspective. Then, kind of your time as CEO. I mean, firstly, I would really love to know, how does one find out they're going to be the CEO of an international bank? How did you find out? Was it a phone call or?
Well, 7 years earlier, I was running the investment bank and the asset management business, and John Varley was running the retail bank. John's British, I was American. John was the retail bank, which was really the core business. I was the investment bank, which was kind of seen as the interlopers in some ways. John was younger than me. We had both been on the executive committee for over a decade. And I was not surprised that he was selected as CEO over me. In fact, probably until about a year before the decision to choose a new CEO, John had always been thought of as the next CEO, and I had never been considered. In the final analysis, we had really been successful in building the investment bank and the asset management business. So I was a candidate. And the big decision for me was if John became CEO, could we work together? And is there a chance for me to be CEO? Or if I want to be CEO, do I have to go to another bank? Because, and anyway, John and I had a very good conversation, and I congratulated him because he deserved it. I would have loved it, but as I said, I wasn't surprised he was the choice. I think he was the leader. And he said he planned to have 7 years, and he would love me to stay. And I had to think through whether I was willing to wait 7 years to become CEO. And I think I really loved the job. I loved the firm. John was a great partner and a great boss. He hadn't been a boss before that, but he was now my boss. And I made the decision that I would work for John. And I knew that sometime around that 7 year time, if you step down, and I said to him, I'm not going to hold you to the 7 years. You don't take that as anything. But I think we'll talk closer to the time, and I will need to make a decision to leave a year or so before you, or to stay and compete for CEO. But we have 4 or 5 years until then. So we stayed in very good contact. There were no guarantees. There were no promises. But by the time his time came up, it was pretty clear I was the leading candidate. So it wasn't like there wasn't a big moment, because we had talked about it for a number of years. John was great in succession. In fact, the surprise to me was that once I was announced, about 6 months before I would take over from John, he basically said, you're ready to go. I'll leave a little bit earlier. You just take over. So it was a great relationship. John was a great CEO of Barclays, a very, very good boss. We were serious competitors leading up into him becoming the CEO. But I think it's a testament to both of us that we found ways to work together and actually to become very, very, very trusted colleagues and supporters of each other.
As CEO, what are the lessons? What was kind of the decision making? Day to day, what did that look like? What are the kind of principles?
I think the single hardest part of being the CEO of the bank was recognizing that I was now, for the first time, running businesses where I wasn't a subject matter expert. So in going from, and it's a bit of a stretch to say I was a subject matter expert in investment banking, because I had a narrow background in technology, fixed income, and then I was running a global bank that was involved in much more than that. But I'd been 13 years at Morgan Stanley and 4 years at Credit Suisse First Boston, and now, at that time, over a decade at Barclays. So I was a real expert in investment banking. Now I had a retail bank, I had a commercial bank, I had a credit card business, and I was far from an expert in any of those. And I think The greatest challenge and test is being as strong a leader of a business where you're not the subject matter expert as you are if you are a subject matter expert. And I think one of the things I learned, which was very, very healthy, is in some cases you're a better leader if you don't think you can do everyone's job. Because if you have this feeling that you can do everyone's job, sometimes you're a little bit too close. You're not standing back and delegating enough. So I think a lot of it was the biggest challenge was recognizing that I was running businesses where I had to really, really count on the people to be subject matter experts. And then the second was there was just a much, much bigger component of focus on stakeholders who are not running the business day to day: governments, regulators, media, and the public. And I think that was the other big piece.
And I'd love to know as well, before we move actually on to the current market views, as CEO, but even also now, there's such an information overload in the Financial Times, the Bloomberg Terminal. There's so many different sources of information. How do you, on a day-to-day, build your worldview, and kind of how generally do you? I know you obviously have so much experience, and that ties into your worldview today. But how do you sort of take a view on what's going on?
It's a great question. I think today, much more than 20 or 30 years ago, you have to be really, really disciplined because there is so much data, so much information, so many high-quality analysts and publications that you run the risk of just, reading too much, and it's not focused. So I have a select number of things that I read every day, and I have to put other things off. And it's been very hard for me to recognize that, this person is really, really good at analyzing things and really good, valuable information. But I can't jump in and jump out. You have to kind of focus on a certain number of things to read. One could just read all day long. That wasn't always the case. I think that's probably the most important thing. I think the second thing that I do is both at Barclays, but now in my smaller business of Atlas Merchant Capital, I give a public update on my view of the world, and the world is a little bit grand. I don't mean it to be so grand, but a macro update of what's going on with the Fed, what's going on with the economy, what's going on with banks in Europe versus banks in the US. And I do it quarterly. And I do it so, people can listen in, but there's also, it gets posted. It's like we don't call it a podcast, but it's the equivalent of that. The beauty of that is I can't do it if I don't prepare for it. And so it kind of forces me once a quarter to really think through in a very disciplined way what my thinking is on the major trends impacting the world and the economy and the financial markets. I would add into that I still, I guess I convince myself it's good for our brand and reputation for me to be on CNBC from time to time and Bloomberg. But I think it's actually because I like doing it. It forces me to think through what I'm going to say. And I never go on, even for a 10-minute interview, without spending a little bit of time thinking through, in an organized way, my thoughts. And I think those are the most important parts, is it's not just the discipline of what you read and how much time you spend on it, but it's the discipline to put your thoughts into a coordinated, focused way so that if asked a question, you have a coherent answer. The process of preparing for that, I think, is very healthy.
And are there any specific people? I'm a big fan of Howard Marks's memos. Are there any people that you particularly really like their analysis there?
I think Ian Bremmer is terrific. I read him every week, Eurasia. My Bible is my conversations every week with Larry Cantor. Larry does the quarterly update with me, which your readers should all check out. We do it with Worth Magazine, Larry Cantor and I. Larry was worked with the Fed during the Paul Volcker days. then was chief economist at JP Morgan. We hired him from JP Morgan into Barclays to be our chief economist. He then became our head of research and economics. And post the Lehman acquisition, he was the #1 rated research department on Wall Street for a number of years. He's retired, and he and I give the quarterly update together. So by doing it with Larry, I learn a lot every quarter. My name is out there, but it's really Larry's research and Larry's thinking. But he's the best.
And you just mentioned CNBC and Bloomberg. I've, preparation for this conversation, I've been watching your Bloomberg's going back quite a number of years, but I'm wondering, because I was just watching you the other day, last week actually, and you were talking about how the sort of US debt and deficit is this cloud over the US, cloud on the horizon, I think you mentioned, for the US economy. But I'm wondering as well, because I read like The Alchemy of Finance by Soros, and he talks about this in the 80s, and it seems like it's been talked about a lot. Obviously it was a lot smaller then, like 2-3 trillion US debt. Now it's like over 36 trillion. I would love to get your perspective on the US debt and US deficit, because I think it's quite an important topic, and I feel it wasn't really mentioned much in the US election at all. But yeah, I suppose I'd love to get your view on the economy today.
It's crazy that it was not mentioned much. It was not mentioned almost at all in the election. 36 trillion. Can you imagine that number? And it's hard to even conceive. Now, even more, when former President Trump started in office in his first, 8 years ago, it was about half that. So in the last 8 years, we've doubled the outstanding debt from about 16 or 17 trillion to about 36 trillion, as you say. I may have those numbers a little bit off, but basically double. It hasn't exactly been a trying economy. Most people would say the US economy was leading the world during that time, and yet we borrowed that much money. Whether Harris or Trump won, we're going to increase the debt levels. And I think we're just ignoring this, and it has to be, I think it's why the 10-year and the 30-year bonds in the US have not rallied. Well, everything else over the last couple of months with interest rates coming down seem to be, the equity markets are up, short-term rates are lower. But I think we have we'll have a very, very stubborn interest rate level for US credit in the 10-year and 30-year area. It's already starting to feed in that our debt levels are just too high and how we're going to pay them back. I would expect that at the end of Trump's 4 years, it'll be significantly higher based on everything I've seen so far. Some optimists say, well, his Department of Governmental, whatever it is, he's going to take out a lot of costs. It remains to be seen. I don't see any sign from either the Democrats or the Republicans that we're not going to continue to increase the debt levels. And I think it's the biggest cloud hanging over the horizon, because away from that, God, you just look at the US economy and, during difficult presidencies and COVID and higher interest rates and lower interest rates, it just continues to perform. So there's a lot of positives, but we have one massive cloud hanging over the horizon, and it's the debt levels of the US.
And I suppose touching on the view of the dollar, and then also crypto as well. I saw the price of Bitcoin is approaching $100,000 now.
Missed that one too. The dollar is interesting. I think I really thought a lot about this. It's very legitimate to question, given all I've just said about the debt level, then to question the validity of the dollar as the reserve currency. The problem is there's no legitimate alternative. It's not the euro. It's not the Chinese yuan. And I think it's a big reason why gold and Bitcoin have been rallying is if you think about them, they're really a store of value outside of the government and frankly outside of the debt levels. So I think there's other reasons why Bitcoin has rallied, and there's other reasons maybe why gold has rallied, but Actually, I don't think there's many other reasons why gold is rallied. I think it's primarily that. So I think it's a challenge going forward that if the debt level is not dealt with, wither the dollar. But the real question there is, what's the alternative?
So buying Bitcoin to...
I would have a hard time putting all my savings in Bitcoin, but maybe that's the conclusion some people have come to. Since the Roman times, people have looked in times of crisis for a place to put their savings, for a place to store value away from the control of the government. That's really what Bitcoin is. How do we store value away from the control of the government in power? Whether that's 100,000 or 400,000 or 50,000, that I can't tell you. But I can tell you that there's a reason that both gold and Bitcoin are increasing in value. I have a hard time analyzing. I can analyze I look at the maturity and the interest rate on a bond, and I can do a lot better job of explaining the price than I can with Bitcoin and gold.
I mean, it makes sense. And then I suppose, looking at the next 4 years, this is also something you spoke about on Bloomberg Surveillance last week. You talked about less regulation. I mean, in your view, what does the next 4 years look like? And I suppose specifically towards the financial services sector. I know Jamie Dimon has been an advocate for deregulation, and you've spoken about the consolidation as well of the 4,500 regional banks. Maybe you could talk about this investment opportunity.
Yeah, listen, we at Atlas Merchant Capital believe that the single best opportunity in financial services is right in front of our eyes, and it's the U.S. regional and community banks. There's 4,500. They are very important. The service they provide to small and medium-sized businesses is so much better than the service provided by the big four banks. They just don't care about those small businesses. I know they will say they do, but it's unsurprising that family offices and small businesses tend to do their businesses with Corp, and before it was taken over First Republic and now Safra Bank. I mean, it is a great service, and it's a real underpinning of the strength of the U.S. financial services industry. But they don't need 4,500. And many of the 4,500 today, with the push by the regulators and the Fed to invest in technology, which is necessary, with the intrusion of the regulators post the collapse of SVB and First Republic, many of the very high quality but tiny private community banks are just too small to succeed. If they're merged with successful regional banks, the synergies are almost immediate because they're very much cost of technology, cost of regulatory. So we believe that we'll see a consolidation from 4,500 to something closer to 1,000 in the next 2 to 3 years. And we think that with that comes a fascinating ecosystem of capital relief trades, of spinouts. When Bank A buys Bank B, there is a rule that Bank B has to mark everything to market. Once everything in a bank is marked to market, it means basically maybe you sell it, maybe you spin it out, maybe it's not core, but there's no big valuation issue in trying to do that. So we think it's going to be an incredible period of 2 to 3 years of consolidation. We think the impact on the kind of the ecosystem of credit will be real. We don't believe that even a more regulatory light Trump administration wants the large four banks of B of A and Wells Fargo and Citi and JP Morgan to become bigger and more concentrated. They're already far bigger and far more concentrated than they were in 2008. So we believe that private capital, foreign capital, coming in to be invested in this sector is a great opportunity.
And I know you've talked about you can't predict the next crisis. But if you had to, what keeps you up at night today? And
Absolutely nothing.
nothing. Okay.
I sleep very well.
I then suppose moving on to other kind of investment opportunities. I read an article that Henry Kravis of KKR, he said that if he was 30 years younger today and he spoke fluent Japanese, he would go to Japan because there's such an opportunity with these publicly traded Japanese companies trading below their book value. I mean, you spent time obviously in Japan as head of Credit Suisse First Boston. Firstly, what are your views on Japan today? And then also, I suppose the question to you, if you were 20, 21 years old, you could speak any language, where would you go? Would it be the US, London? Where would you? I'd love to know.
I'm very positive on Japan. I think, the challenge of demographics is really the only challenge they face. It's a big one. I think they have to come to grips with an immigration policy, but it's very hard for a country that is, integrated as Japan is. Our family lived there for 3 years and had a wonderful, wonderful time. It's a great country. They run businesses incredibly well. It's very safe. It's a great culture and it's a great country. So I'm all positive on that. I think in terms of if I were maybe not in my 20s, but if I were in my early 30s when Morgan Stanley offered me the opportunity to move to London, I think the Middle East is still an amazing place. Living in Abu Dhabi or living in Doha or living in Riyadh, I think the continued growth of kind of those three countries and the financial centers in those countries, I think they're stealing the march from kind of, I don't want to say the demise of London as a financial center, but I think the UK has not done what they could have done to keep London as the most attractive financial center in this time zone. And the Middle East is not that far away from a time zone. It's kind of halfway between Tokyo and London. But the wealth creation, the lifestyle, the light touch regulation, I think are all very attractive right now. And I think over the next 10 years, it would be a very interesting place for someone in their late 20s, early 30s to go. If not for a decade, for a few years at least.
I'm just looking at the time. I would love to get your advice on leadership and also for students. But I suppose starting with leadership, what do you think are the key characteristics or key qualities or skills you should learn to develop to become a great leader?
Listen, I don't think people think of it as training to be a great leader. I just think that everyone should be, my principles are always work your hardest. Second principle is that open and honest confrontation is positive. It doesn't have to be aggressive. It doesn't have to be nasty. But people should find a way to say what they believe in an open, honest way in front of people, not behind people. And that leads to a very, very strong culture. But most of all, I think if we just get up in the morning every day and recognize that if we work our hardest, good things will happen. Take it from there.
And your advice to students today listening at Trinity, considering a career in finance?
I think finance is a fascinating career. I fell into it. I've loved every single minute of it. I think it's up to the individual. One of the questions I get asked often is, is it still good to go with a big bank, or is it good to be kind of in the non-bank area? I just, even today, I don't think there's a better way to get trained than being with one of the big banks. I think one of the challenges they have, and I've heard some of the CEOs talk about it recently, is they get frustrated by how many people come and plan to just be there for a couple of years of training. And I think that is a challenge. And I'm not saying people should go and leave after 2 years or 1 year or 3 years. But I do think that there's many opportunities outside of the banks as well. So I think people should be open to it. But I think if they have the opportunity to spend a couple of years at one of the larger, more integrated platforms, there's no better training. And I guess I'd add one other thing. That training is great for life, even if you end up working outside of the financial services industry. My daughter has her own business in fashion. She spent 2 years at one of the big investment banks. And while she didn't want to stay and have a career in finance, I think she'd be the first to say that the experience was extraordinary. She doesn't regret a single minute of it. It just wasn't the industry she wanted to be in.
So, Diamond, thank you so much for the time. And
you're very welcome.
Thank you so much.
Thank you. I'm impressed with how prepared you are and organized. So it augurs well for B of A Merrill Lynch in their hiring of you. Good luck.
Thank you very much. You have been listening to the Trinity SMF podcast. You can find more of this podcast on our website, www.trinitysmf.com, and follow us on our social media to find out more about the podcast releases, upcoming events, and much more. Thank you again for listening, and stay tuned.